Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 4th of July, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, how tariffs will shape world trade flows and highlights from our latest global economic outlook. But first, Group Chief Economist Neil Shearing joins me to run through the week in macro and markets. Hi, Neil.
Hi, David.
We've got to give the usual caveat, don't we? It's just after 9 a.m. London time. That's 4 a.m. in DC as we're recording this. And not too long ago, we've had Donald Trump saying that letters are going out from today to US trading partners, informing them of tariff rates in the range of, he said, 10 to 70%. Now, these were off-the-cuff comments, so let's make of them what we will. But what does this all mean? What do the days leading up to and the days after the end of this pause on Liberation Day tariffs, which is coming next week, what does that look like? What should we be expecting?
Again, as you say, the usual caveats apply. Frankly, who knows? I think what we're going to see over the next few days are several things. The first is we're going to see countries scrambling to try and do a last-minute deal with the US. Notable that the head of the Japanese trade delegation is flying into DC, we believe, over the weekend, potentially trying to seal a deal there. That, of course, has been one of the more difficult deals to do, sticking points over everything from rice to cars there. Rumours that India might be close to striking a deal with the US. So I think we're going to see lots of last-minute activity as governments around the world try to strike a deal with the US. For those that don't manage to strike a deal with the US, as you say, tariffs on anything from between 10 and 70% potentially coming. For countries hit by that higher 70% tariff, we could see some substantial dislocation potentially, I think, in markets once those are announced in those countries. The key question in all of this, though, is still, where will tariffs land? I don't think that these letters that are being fired off, supposedly from the White House over the coming days, are the final word. I still think that most countries will be hit by tariffs in the order of around 10% by the US, China facing a higher tariff, of course. And importantly, the two deals that have been struck so far with Vietnam and with the UK, I think tell us something about the bigger forces that are underpinning this. They both include provisions that are specifically aimed at curtailing trade with China. In the case of the UK, some language around trying to cut out suppliers that are deemed to be national security threats. In the case of Vietnam, specific tariffs aimed at preventing rerouting of production from China through Vietnam to the US. So that speaks to this broader fracturing of the global economy that we, of course, have discussed at length in the past.
Okay, but our assumption is still going to wind up something like 10% for most countries, China a bit higher than that. These letters could be brinkmanship. We could see extensions once we get to that 9th of July if agreements aren't in place. As you say, the Japanese trade minister flying into DC to try and hammer something out. You've mentioned Japan, you've mentioned China. What about the European Union? Because obviously that's the other big trading partner for the US. How do we see talks going there?
Well, discussions with the EU, of course, are complicated by the fact that it's a bloc of countries, 27 countries, and the US is trying to do deals with governments. So it's got specific complaints against Germany, for example, and German auto producers, it seems. But of course, the EU is trying to speak with one voice. The European EU trade policy is set at a block level. So that makes it harder to do a deal. And I think that's why we're seeing these sticking points emerge. And another point worth stressing is that while China has been the focus by virtue of its large trade surplus with the US and this deepening superpower rivalry between Washington and Beijing, something that's overlooked, I think, too often is just the sheer size of not necessarily the EU's current account surplus, but Germany's current account surplus is enormous. So I think there are genuine grounds for concern and complaint, if you like, against the size of Germany's surplus. The concerns are genuine, I think, but doing something about it, striking a deal, is more difficult because you have to operate at a block level. And of course, as we've talked about before, tariffs are not the way to deal with trade imbalances. Now, what does all that mean? I suspect it means that if you take what I just said about the UK and Vietnam, the US, for all of these complaints, is still going to try and keep, I think, Europe in its orbit, within its bloc, in its alliance. It's still going to try and coerce Europe, if you like, to push back against China too. So it's not going to want to push Europe away completely. It's not going to want to take too aggressive and belligerent a stance. So, again, a 10% tariff, I think, feels like a reasonable baseline. I think the auto sector will probably get hit with a higher tariff by the looks of things. EU leaders will talk a tough game, will talk about pushing back and not being bullied by the US. And then when they do actually ultimately retaliate, it's not going to really amount to much, I don't think. That's been a repeated pattern in trade skirmishes with the US over the past decade or so, that they talk about pushing back, talk about retaliation, but that retaliation amounts to some higher tariffs on Harley Davidson's, bourbon whiskey, and so on and so forth. So possible that a deal gets done, I think, if not the first half of this week, then at some point over the next month or so, they'll agree the contours of a deal that might reduce tariffs for a period until a deal is signed. But it won't be the final word again. And strains and tensions between the EU and US are going to be a recurrent theme through this administration.
You mentioned that Vietnam deal. It's really interesting, isn't it? I think it's probably worth spending a little time talking about it. So, as you say, very few details so far, not much from either the US or the Vietnamese sides. It sounds like a 20% tariff on Vietnamese exports is a baseline, but 40% on transshipped goods. China not mentioned there, but clearly aimed at China. The Chinese response has been predictably gruff. I'm paraphrasing MOFCOM, but it's basically this line about we oppose attempts to freeze us out of trade and with threatening countermeasures. If you're a Vietnam or if you're a Cambodia, even, for example, you're massively export reliant with a big chunk of exports going to the US, suddenly you're in this position of having to pick a side, aren't you? So how do we square these attempts to stop the rerouting of goods through these third countries like Vietnam and Cambodia, and basically giving these countries a sort of you're either with us or against us ultimatum? And at the same time, you have this track of US-China talks in Geneva, in London, to try to stabilize the relationship, address at least some of the grievances in there.
As ever, I think that there are multiple objectives going on here, aren't there? And trying to, on the US side, and trying to rationalize all of those and embed them within some kind of coherent framework, I think is challenging, to say the least. If we try to square things, we're playing in an impossible game where things don't square, and maybe that's intentional, or maybe it's to do with a kind of fault of the strategy. But as it relates to Vietnam, I think there are a few important points to make. You're right, we don't have very many details, but it appears that they're going to face a 20% tariff. The UK, of course, had a 10% tariff in its deal. At face value, Vietnam has a worse deal, therefore. But of course, Vietnam had much more to lose. It was one of the three countries that we identified at the very start of this trade war as having the most to lose. About 25% of its GDP is derived directly from exports to the US. That compares to less than 2% in the case of the UK. So it had much more to lose, and that has pushed it to cut a deal. And of course, it faced a much higher tariff from the US on that billboard that Trump had on Liberation Day of different tariffs. Vietnam had one of the highest rates. I think it was over 45%, 46%, something like that. So Vietnam had much more to lose. That, I think, explains why it was keen to cut a deal and why that deal ultimately landed at 20% rather than the 10% baseline that the most countries seem to be aiming for. Second point is that because we don't have many details, the really critical component here is what is happening to the electronic sector. If you remember, in the wake of those Liberation Day tariffs in early April, about a week later, if media reports are to be believed under pressure from Apple, the US administration exempted shipments of electronic goods from Liberation Day tariffs. And a large chunk of Vietnam's exports to the US, about a third actually, are electronic goods. So if that exemption remains in place, they remain zero rated effectively, then that will bring the effective tariff rate faced by Vietnam down. And then the third point is exactly the one that you make about transshipment and China and the US and how all that fits together. I think there's a slight danger in all these countries that have essentially turned themselves into or been turned into transshipment centers for Chinese producers. If you're perceived to be a way of getting goods into the US via the back door at a lower tariff rate, that comes with huge risks, I think, because if you think about how that plays out, what it means is that all the value added is happening in China. All the jobs are in China. All the production is in China. It's then put on a boat, shipped to your country, whether it's Vietnam or Mexico, reboxed, rebadged with almost no jobs, no value added created there, and then stuck on a boat, sent to the US. And in the trade statistics, that shows up as your trade surplus with the US. So you're running, if you're Vietnam, then an enormous trade surplus with the US. You're putting yourself in the firing line, but you don't have any of the benefits of the jobs, the value of production that goes with that. So I think this trend towards transshipment carries enormous risks for the countries that sit in the middle. And so I think that probably explains why Vietnam itself was happy to sign up to these conditions and this higher 40% tariff on goods that are transmitted through Vietnam, because ultimately it doesn't have very much to gain from that trade.
So we're talking about the expiration of this pause on Liberation Day tariffs as if, US tariff levels were still quite low. They're not, are they? The effective tariff rate's just under 20%. So let's talk a bit about how, as these tariffs came in, there were lots of warnings about the negative impact they would have on the US economy. So let's talk a bit about the data. I mean, if it were possible, Trump is sounding even more emboldened these days than usual. And I think some of that is because the data hasn't been cratering, has it? So talk about the latest data about how activity is holding up under these tariffs. We've had global PMIs over the past week. We've just had fresh payrolls numbers in the US. What are they all saying?
Well, they continue to paint a picture of an economy that's slowing a bit, but not really collapsing, and has proven to be pretty resilient in the face of these tariffs. Now, some of that is because there has been front running of tariffs. Firms have got ahead of the tariffs by importing an enormous amount in February and March. That's padded out inventory and allowed them to delay the pass-through in costs from tariffs to consumers. And one of the questions we get asked all the time is, why have we not yet seen any impact on inflation in the US from tariffs, and when will that impact come? And I think the answer to the first part, why have we not seen any impact, is because of this front running and because supply chains are incredibly adaptive and flexible. When do we start to see it? I think the answer is probably over the coming months we'll start to see the effects of these tariffs. I think we'll start to see maybe June data, probably in the July data would be my guess. But even then, our view all along has been that imported goods are equivalent to only about 10% of GDP in the US. If the tariff is therefore, if the average tariff rate goes up by, say, 10%, then that's a headwind for the US economy, but it's not an existential threat. So the economy holding up, appearing to be relatively resilient, and tariffs not an existential threat, probably not going to be pushing the US economy into recession as some had speculated. The payrolls numbers themselves, the US labor market is holding up too. The economy added 147,000 jobs in June. If you dig beneath the hood, while that headline number is pretty good, the details aren't quite as encouraging. A lot of that addition in jobs came in state and local government, and in particular in education. The private sector added just 74,000 jobs last month. But bear in mind that the labour force is growing at a much slower rate now too. And indeed, the unemployment rate actually edged down in June. So the US economy doesn't need to generate as many new jobs in order to keep unemployment from going up because of immigration curbs and so on and so forth. So for now, I think if you're sitting at the Fed, which is obviously the critical issue for markets here, you're all thinking that there's no rush to cut interest rates. We saw yields shift up by about 10 basis points in response to those payrolls numbers, pretty much along the curve, particularly at the short end. The market now taken out any prospect of a rate cut this month by the Fed and marking down the probability of a rate cut in September too. That's good for our call, of course. We've argued all along that we don't think we're going to see rate cuts this year. And the data so far, I think, still support that idea.
Okay, it's July 4th. It's a good day to talk about taxation and representation, isn't it? Trump's big, beautiful tax bill made its way through Congress, is going back to his desk for him to sign today. I wanted to throw two views on this. I'd be interested in your take. So the first is Treasury Secretary Scott Bessent. He said, quote unquote, the bill could lead to 3% economic growth by next year and reduce the federal deficit by approximately $300 billion annually. And then Paul Krugman, the economist, who said this bill will add, quote unquote, trillions to the deficit, even as it causes mass misery. What's the capital economics take?
As ever, the truth is somewhere in between. Look, I don't see how you get to 3% growth next year in the US, particularly if you're continuing to curb immigration, and that is having an impact on labor force growth, as we've just discussed. You're going to have to get almost that 3% growth is going to have to come almost all from productivity growth. And I just don't see how that's happening. I don't see that this is going to be generating much in the way of growth. And I've also got some sympathy for the fact that it's a pretty reckless way to run fiscal policy, frankly. The big difference now is not so much the size of the deficit or indeed the debt burden that concerns me. It's the fact that we have these deficits and this debt burden at a time when the US economy is at full employment. So it's one thing running a 6% of GDP, 7% of GDP deficit in, say, 2010, in the wake of the global financial crisis, when you have unemployment still elevated and private sector demand weak. That is not the situation today. The situation today is that unemployment's close to record lows. And as we've just discussed, the US economy is appearing pretty resilient. So there is no justification for running deficits on this scale. So yes, the president might be a self-styled cost-cutting Republican, as he put on a social media post earlier this week, but there's no evidence whatsoever of that in this bill. It seems that politicians on both sides of the aisle, going back probably from the last 2 or 3 administrations, have shunned taking the difficult decisions that are necessary to put the US public finances on a kind of more sustainable track over the long term. Now, does this create mass misery? I'm not going to get into the politics of some of the spending restraints around Medicare and Medicaid, but I don't think it tips the US economy into some kind of calamitous recession either. It's quite difficult to do that if you're running a budget deficit of 6% of GDP, just sustains demand. The big risk here, of course, is that at some point the bond market's patience will snap. And at that point, yields surge, and then you get a tightening of financial conditions, and then you do start to get problems in the real economy. Now, judging when that point comes is incredibly difficult. The dangers of it are increasing because we're running these big deficits at a point of full employment. But for now, at least, as I say, yields over the past week down, the bond market seems to be taking this in its stride.
Yeah, so compare and contrast the passage of that bill with what happened in the UK over the past week. We had Keir Starmer in the Commons on Wednesday with Chancellor Rachel Reeves by his side. They've just U-turned on some big spending cuts that they were trying to push through, lots of opposition to that. They had to backtrack in the face of a party revolt. The Chancellor is sitting next to the Prime Minister, looking visibly upset. The Westminster speculation machine goes into overdrive about what's happening. Now, I don't really want to talk about that, but what I would be interested to hear your take on is how quickly and negatively UK bond and currency markets reacted. So what does that tell us about the state of the UK fiscal picture?
Yes, pretty unedifying scenes in UK Parliament, that's for sure. But the reaction in bond markets was interesting, as you say. So we saw this pretty rapid increase in yields, up 15 basis points, up 20 basis points at one point, I think, at the 10-year part of the curve. As the Westminster rumour mill got into overdrive and there was speculation that Reeves had either been pushed out or was going to offer her resignation. Now, why is that the case? I think it's all because of the perception in markets that of all the Labour front bench, it's Reeves that is the one that is the kind of fiscal hawk. Throughout her past year at the Treasury, she has asserted the importance of what she calls ironclad fiscal rules. And of course, although there's the devil in these rules is always in the detail, that has boxed the government in and forced it to make some pretty difficult choices around fiscal policy, which came to a head with the welfare bill that they faced a big revolt on earlier this week. So I think any sense that she was on her way out might be good news for Labour backbenchers that want a softer, a more relaxed approach to fiscal policy, but bad news for the bond markets. And I think there's a lesson here for other countries, right? UK fiscal policy did not change on Wednesday, but what changed was a perception that the personalities and the people driving UK fiscal policy over the coming months and quarters and years could change. And credibility really matters here. And coming back to your question about the US and the deficits and debt there, then Scott Bessent plays an incredibly important role here. He has the trust of the markets. He's obviously a hedge fund guy. The bond market believes in him. He pulled the US back, according to media reports, from the brink at the height of the trade war. And if you apply the lessons from the UK to the US, then any sense that Bessent has fallen out of favor with Trump, or any attempt to remove Bessent from Treasury, I think could be pretty chaotic. It could create some pretty chaotic scenes in the bond market. And of course, there's lessons here for Europe as well. We have at Campus Economics, as ever, one eye on Eurozone public finances and fiscal risks, a French election due in 2027, potentially the next big flashpoint coming. And again, any sense there that personalities are shifting, composition of government is shifting in a way that might erode fiscal credibility, I think, again, could spell trouble in the bond market.
Neil Shearing there on tariffs, fracturing and fiscal risks. Small clarification, that US effective tariff rate I mentioned is now 16.1%. I know that because I double-checked our tariff impact model, which lets you set country and sector-specific US tariffs to see how economies are affected. I'm going to add a link to the podcast notes so you can play around with it, download all the estimates that you might need. We are watching this situation very closely, and as it develops, we'll respond with rapid reactions, in-depth analysis, online briefings, data resources, a complete set of tools to keep you on top of what's happening. This is US policy that affects pretty much everywhere in the global economy, so don't forget that CE Essential and CE Advanced, our all-access packages, give you the full picture, plus data, plus ways to engage directly with the Economist team. If you don't already have access, get in touch and we can get you set up pronto. Neil and I were discussing transshipments. It's a core issue in this trade war, and it's just one way that Chinese manufacturers are changing tack as tariffs bite. There's also offshoring, there's trade diversion, and you'll want to see our China-US trade rerouting dashboard to see how this whole trend is evolving. The dashboard captures how this activity is shaping China-US trade flows, but it's also got on-the-ground views from conduit economies like Vietnam that really gets to the heart of what the White House is moving against. I'll add a link to the China-US rerouting dashboard to the podcast notes. Also on data, Neil mentioned those Eurozone fiscal risks, and we have an interactive dashboard all about that as well. I'll link that to the podcast notes too. Now, Neil and I were running through the latest news flow on this tariff story. That news flow is feeding a much bigger and longer term view of how levels of world trade are going to be affected by these higher US duties. But there's a lot of misinformation out there, and there's some pretty grim forecasts too about what lies in store for global trade. Some organizations warning of a near 6% hit to GDP by the end of next year. Ariane Curtis, a senior economist on our global desk, has been crunching numbers, and she's just published an in-depth report on the world trade outlook. I spoke to her earlier, and I started by asking what's in store for global trade, but also about the genesis of her new report.
Yeah, so with everything going on with tariffs, what it means for relative countries, some clients were asking, and we thought it's worth stepping back to look at what's really the big picture for global trade flows. What does this mean on aggregate? What we found is that we expect that there will be some weakness in global trade in the near term, at least. Our baseline assumption, which incorporates tariffs of about 10% on most countries and 40% on China. We estimate that this would mean world trade falls by around 1% over the next 2 years, and that would cause global trade growth to slow from 2.4% last year to around 2% this year and 1% in 2026. The reason for this is mostly because tariffs are going to weigh on aggregate demand somewhat. And through this trade, as GDP growth slows, so too does trade growth. But there was also the question on what about if tariffs, are they going to have a more structural or permanent impact on world trade? So, i.e., would this cause global trade as a share of GDP to decline? We thought this could happen if tariffs cause a reorientation of global supply chains in a way that they become less trade intensive. But our view really is that tariffs, at least at these levels, won't really have much of a big structural effect in this way. That's predicated on a few assumptions, one being that retaliation remains limited and that there's not really a broader protectionist shift where other countries start imposing tariffs on each other, not just the US. Crucially, we think that there's going to be significant trade rerouting of China's exports as was the case in Trump's first term. And we also think there's pretty limited scope for significant reshoring of manufacturing production to the US, although this seemingly is something that Trump is aiming to do. At this level of tariffs, it's not really viable for much reshoring to the US. What it all means is that in aggregate, there's no really big effect on supply of traded goods.
That's quite a key point, isn't it? I mean, is there a risk that we're being a bit too relaxed about this? Because your report does highlight some pretty grim forecasts from the likes of the WTO for how tariffs are going to affect global trade at a structural level. So why are we somewhat more upbeat?
Yeah, you're right. We do generally lie below what we've at least read from other researchers' projections. So maybe at face value, it looks like we're a bit too sanguine. But it's worth taking note that all these projections are based off different assumptions. For example, the tariffs could reduce global trade by anywhere from 2.5% in the IMF's case to as much as a huge 5.5% in the CEPR's case. That's because they incorporate much higher tariff assumptions. They include the US effective tariff rate rising by about 23 percentage points, which basically is predicated on tariffs returning to either their Liberation Day rates in most countries or this 145% rate on China that we saw temporarily, whereas our forecasts incorporate an 11% rise in the US effective tariff. So that's really a huge reason for the difference. Also, the WTO and CEPR assume that there will be some retaliations, especially in China. And they seem to assume that there will be more reshoring than we think is likely. So they see this structural supply side shift being a bit more affected than we do in our base case. So yes, we're different, but there are reasons for these divergences.
CEPR, that's the Center for Economic Policy Research. I wanted to ask the big question here, the big debate is whether all of this means that the global economy is basically deglobalizing now. Talk about what your analysis says in terms of this question about whether we're now in this phase of deglobalization versus the rapid increase in globalization that we saw certainly at the beginning of this century.
Yeah, there's a lot of kind of headlines where you see deglobalization, is globalization at an end? For what it's worth, we don't think that tariffs really mark the start of a period of significant deglobalization. We've already actually been arguing for some time that we're past the peak of globalization. And really, this bigger structural shift took place after the global financial crisis almost 2 decades ago, when years and years of progress towards a more globalized trading system plateaued. We can observe this if we look at what's happened to global goods trade as a share of GDP over the years. So this was rising steadily during the 1990s and early 2000s, but it's really flattened off since the financial crisis. Really, we just think tariffs are basically a reason for this trend to continue, not necessarily for trade's kind of importance for the global economy to fall much from here and for trade as a share of GDP to decline significantly.
Okay, before you go, I just wanted to pull back a bit from the global trade picture, look at the health of the global economy more generally. Our global economic outlook, it was out this past week. And I thought I could ask you as lead economist of that report, what's the main story? What's the elevator pitch?
Yeah, so some of it's similar to what I've been saying on the global trade front. We expect global GDP growth to slow somewhat in the next 2 years. That's partly due to tariffs. But we're not really expecting a global recession by any means or any really permanent impact from tariffs. On the inflation front, we think that inflation should continue to moderate in most countries, which should let central banks continue to cut rates in the coming quarters. But the US is really a key exception here because we expect tariffs to cause this temporary rebound in core goods inflation later this year. And that will mean that the Fed probably will stay on the sidelines this year while other central banks can continue cutting interest rates.
Okay, and within that, give us a couple of bright spots, but also give us a couple of examples of economies that you think are particularly concerning.
Yeah, so some of these underperformers, In the US, as I mentioned, growth is going to slow due to not only Trump's tariffs, but also his immigration policies. So interestingly, this period of US outperformance that we've become accustomed to in the past few years relative to other advanced economies is going to come to an end. And we actually are going to see those growth rates converge over the next couple of years. China, another major economy where the outlook is pretty weak. Exporters face various headwinds, not only from tariffs, but also from a fading boost of the weaker renminbi. And fiscal policies are going to do pretty little, we think, to boost domestic demand there. So in terms of our China activity proxy measure, we would expect growth to slow from about 5% last year to only 3.5% this year, all the way down to 3% next year. But it's not all doom and gloom. We do think India is one particular bright spot. In fact, they've already gotten off to a very strong start of the year in Q1. And one of the reasons for the more positive outlook is relative to other economies, it's pretty sheltered actually from US tariffs. So we expect GDP growth to be about 7% there in the next 2 years. So that's one outperformer, if you will.
Ariane Curtis there on the Global Trade Outlook. I will post her trade report on the podcast notes. Do take a look at it over the weekend. It might provide some comfort as Trump tariff letters wing their way to governments worldwide. But that's it for this week. Happy Independence Day if you are celebrating. The Capital Economics team will be back next week with more from the world of macro and markets. Until then, goodbye.